For decades, Canadians have lived by a rule. Pay off your mortgage before you retire. That was the dream. Retire debt-free, live comfortably, and pass your house down to your kids. But consider Paul and Anita from Mississauga, who did the opposite. They retired early in the early 60s, and they still had a mortgage, not by accident, but by design. That decision completely changed their retirement story. So let's unpack that story. Paul's 61. He worked in IT for nearly 30 years, the kind of job that's stable but very demanding. Anita, 59, spent her career as a nurse. Together, they raised two kids in a modest detached home in Mississauga, and which they bought in 1994 for about $260,000. Back then, that was expensive, but manageable. Fast forward 30 years, their house worth about 1.3 million, but like most Canadians, they weren't mortgage free. They still owed around $180,000. And here's where most people would start to panic. We can't retire until the house is paid off, right? That's the mindset we've all been taught. But Paul and Anita asked a different question. Instead of waiting until you're 68 or 70 years old to fully pay off the mortgage, and who knows what happens by then, what if they could retire now at 61 and 59? What if they could spend time with grandkids, travel while they're healthy, and finally slow down? They didn't want to waste what they called their young retiree years just shoveling money at the bank. And I can speak for personal experience. My wife and I, about 10 years ago, we decided to travel all over the Prague, Vienna, Budapest, Hawaii, Mexico, Barcelona, France, etc. And you know what? It was a good thing we did because my wife has worked her whole life as a hairstylist and eventually her knees gave out. She was bedridden for I don't know how long, waiting for a new titanium knee. And during that time, there's no way that she could have traveled the way that we did when we did. So you have to think about these things. I mean, it's not just your knees. Maybe it's your entire health that you're sacrificing, waiting for the right time to travel, and then you can't. Or waiting for the right time to relax or spend time with family or grandkids, and you can't. You have to think about these things. So Paul and Anita, they broke the rule. They retired with a mortgage. And not only did they make it work, but they built a retirement that gave them more freedom than if they'd paid everything off. To understand why this worked, you have to understand two things: the financial reality for retirees today and the tools that Canadians can use now, some of which are very misunderstood, like the reverse mortgage. First, very quickly about me and this channel. My name's Peter Fabry. I've been a licensed broker since 1999, and I'm the founder of Rewind Mortgage, this information site, which is a division of my licensed brokerage. You can find all the provincial licensing numbers for the brokerage in the details section of the main page. This channel is all about honest, pressure-free education. So if that sounds good to you, hit subscribe. Now let's dive in. In the 1980s, retirement was much simpler. Houses were cheaper, pensions were common, and people lived to about 75. Paying off the house by 65, that was totally realistic. Today, not so much. The average Canadian home now, 8 to 10 times what the average income is. More if you're in a metropolitan area like Toronto or Vancouver. Or other cities are starting to get that way as well. In Mississauga, the average detached home is now $1.3 million. Meanwhile, wages barely doubled since the 90s. Pensions, only 1 in 3 Canadians even has one, and they aren't guaranteed income anymore like they used to be. Life expectancy closer to 85. That means you could spend 20 to 30 years in retirement, and that takes serious cash. If you're thinking about going to a retirement facility, any kind of retirement facility, you have to keep in mind that the cost of that could change overnight. You're not locked in at a low price forever. You could run out of money. So here's the kicker. Nearly half of Canadians between 55 and 64, they're still carrying mortgage or HELOC debt. And the old idea of being mortgage-free by retirement is simply out of reach for millions of people. Paul and Anita saw this. They did the math. To fully pay off their $180,000 mortgage before retiring, they'd need at least 7 or 8 more years of work. This meant retiring in their late 60s if everything went according to plan. And we all know that life doesn't always go according to plan. These are valid fears. They'd seen what happened to others. Anita's parents ran out of money in their 70s and had to sell the family home. Paul had co-workers who dipped into RSPs too early, triggering massive tax bills that ate away their savings, and they didn't want to follow that path. The fear isn't just about money, it's about working time. Anita says, what's the point of working until I'm 70 being debt-free if I'm too tired or too sick to enjoy it? That's the real question that keeps a lot of people up at night when they're thinking about things. Time is worth more than money. So what strategies did they look at? Well, they looked at downsizing. This would mean leaving Mississauga, their community of 30 years. A HELOC? Well, that means monthly payment, which you can't afford on a fixed income. That's when they really started to look at the reverse mortgage. The reverse mortgage, here's how it works. A reverse mortgage lets homeowners over 55 access up to 55% of their home's value, tax-free. You can take it as a lump sum or as a monthly allowance or both. You can make payments towards the interest or principal. This amount varies lender to lender, and there is more than one reverse mortgage lender in Canada. You don't have to make monthly payments with any of these reverse mortgage companies. They're highly regulated by the government, and the loan only comes due when you sell, move, or pass away. You stay the legal owner the entire time. So Paul and Anita used the reverse mortgage to access a little more than what they still owed on their mortgage, about $250,000 of their home equity. Again, the home is worth 1.3, so they're dipping into a very small amount of the home's value, and with that they did three things. First, they wiped out the remaining mortgage balance. That freed up $1,500 a month they were paying to the bank. Second, they paid off smaller debts that were carrying high interest. And these smaller things like credit cards, car loans, lines of credit, often they have big payments. Third, they created a travel and home renovation fund. So here's why this was smart. Because the money was tax-free, they didn't have to touch their RSPs. That meant no sudden spike in their taxes, no premature depletion of their savings. The savings can grow, and when the time is right, they'll provide a bigger monthly allowance. Their registered plans stayed intact to grow for later years. So busting the myth, reverse mortgages have always had a bad rap until recently, when thousands of people have realized that they're actually a fantastic product. Paul and Anita's friends told them, the bank will take your house. Well, it only takes a little bit of investigation to realize that's not true, not even close to being true. They stayed on title. The bank is just got a lien on the property just like any other mortgage, like the mortgage they had. Their kids worried that there would be nothing left for them. Also not true. Even if the house only grows at a modest 3% a year, there will still be plenty of equity left as inheritance. The main goal of the reverse mortgage lender is to see your equity preserved. That's the goal. They don't want borrowers to be mad and sorry that they took the product. They want them to be happy they took product and to be comfortable with their decision and to tell others. This is a business. Another concern was, what if you owe more than the house is worth? Reverse mortgages in Canada necessarily come with a guarantee. You cannot owe more than the fair market value of your home. That protection gives anyone who takes reverse mortgage peace of mind. So why did it work for Paul and Anita? It wasn't about spending recklessly or borrowing recklessly. It was about using their home strategically, recognizing that that was their biggest asset, bigger than their retirement fund, bigger than their pensions. Housing in Mississauga has appreciated massively, and sitting on that equity while delaying retirement made no sense at all to them. So instead, they unlocked it. Anita retired at 59. Paul at 61. They spend more time with grandkids. They volunteer. They take one big trip every year, paid in cash, and their house still remains theirs. Their retirement savings are intact, and most importantly, they bought themselves time. So what's the lesson here? For decades, Canadians have obsessed over a finish line, a badge of honor, being mortgage-free by 65. But the reality has changed. Pensions are shrinking, costs are rising, and your home as an asset is growing now to a bigger portion of your retirement equity. Lifespans are longer. The old rule book doesn't always make sense anymore. So the new goal isn't just being debt-free. It's about being life-rich. It's about cash flow, flexibility, and option. For Paul and Anita, keeping their mortgage wasn't a failure, it was a freedom. And they're not alone. More Canadians in cities like Mississauga, Toronto, Vancouver, they're retiring with mortgages more than ever before. The question isn't, how do I get rid of all my debt and all my costs? It's about, how do I use the assets that I already have to live for the life that I've worked? Paul and Anita rewrote the rules, and instead of sacrificing their healthiest years to pay off every last cent, they chose to retire early, stay in their home, and actually enjoy their retirement. That's the bigger story here. Retirement today isn't about waiting until everything is perfect. It's about building a plan that works in the reality you're living in now. So, if you're nearing retirement and staring at a mortgage balance, don't just ask, how do I get rid of this? Instead, ask, how do I get rid of these payments? What could I do if I didn't have to make these payments? For Paul and Anita, that question was the key that unlocked their retirement early. And it might just be the key for you as well. My job is not to sell you a reverse mortgage. It's to outline how they work, to explore different options, and to find the product that's most suitable for you and the lender that's most suitable for you. There are a number of true reverse mortgage companies in Canada. They all have their own bells and whistles. They all have their own features and benefits. They all have their own costs. My job isn't to sell you a reverse mortgage. It's to help you retire with confidence, whatever that looks like for you. Don't forget to hit subscribe if you found this video helpful. Forward it to a friend if you think that they would benefit from it. Stay tuned for the next video. Remember, you can contact me privately or find more information at rewindmortgage.ca or simply leave a message in the comments and I will be sure to get back to you. Thanks so much for watching. Bye for now.